On behalf of the Accounting Standards Board, I am pleased to welcome all participants to this webinar on Ind AS 118 Navigating a New Era in Financial Reporting. With the introduction of Ind AS 118, financial reporting is entering a transformative phase, placing enhanced emphasis on how financial performance is structured, presented, and communicated. The standard brings a renewed focus on consistency, comparability, and transparency in financial statements, particularly in the presentation of income and expenses and the use of management defined performance measures. While Ind AS has always provided a robust framework, the implementation of Ind AS 118 requires careful evaluation and thoughtful application. Entities will need to exercise informed judgment in areas such as classification of income and expenses, identification and disclosure of subtotals, and alignment of internal performance measures with externally reported information. Some key aspects that merit consideration in this evolving landscape include the revised structure of the statement of profit and loss, including defined categories and subtotals, the treatment and disclosure of management performance measures, MPMs, ensuring transparency and reconciliation with financial statements, enhanced consistency in presentation to improve comparability across entities, and the need for clear entity-specific disclosures that provide meaningful insights to users of financial statements. This webinar aims to provide practical insights into these areas, helping bridge the gap between the principles of Ind AS 118 and their real-world application. Through focused discussion and illustrative examples, it will address implementation challenges and highlight best practices. We trust that this session will equip you with the deeper understanding of the standard and support you in effectively navigating this new era in financial reporting. We are privileged to extend a very warm welcome to our esteemed speaker for today's session, C. Harpreet Singh sir. We also have with us CA Gyati Gupta as the moderator of this session. Before we move into the technical discussion, it's my pleasure to introduce her. CA Gyati Gupta is a chartered accountant based in Delhi NCR with diverse experience in direct and indirect taxation, bank audits, and Ind AS based financial reporting. She has a keen interest in emerging areas such as artificial intelligence and actively explores its applications in the field of finance and accounting. She is a seasoned speaker who has delivered sessions for ICAI, ICMAI, and various academic platforms on topics including AI, taxation, and professional development. As an educator and career counselor, she has guided more than 1,000 CA students and freshers, particularly in interview preparation and personality development. She is also a prolific writer and former editor with over 50 published articles that have garnered significant readership across professional platforms. Over to you, Gyati ma'am, for further deliberations.
Thank you so much, Rahul Namani sir, for the introduction, and good afternoon, everyone. A very warm welcome to all the distinguished participants joining us today for this insightful session organized by the Accounting Standard Board of ICAI. And it gives me immense pleasure to welcome you to the 34th webinar on Ind AS 118, Navigating a New Era in Financial Reporting. Ind AS 118, which is centered around presentation and disclosure in financial statements, is a new accounting standard that focuses on how financial performance is presented, especially in the statement of profit and loss. Proceeding ahead, it is my privilege to introduce our eminent speaker for today's session, C.A. Harpreet Singh Ji. A highly accomplished professional, C.A. Harpreet Singh Ji is a rare combination of academic excellence and practical expertise. He's a rank holder across multiple prestigious qualifications. He's AIR 48 in CA, AIR 5 in CS, and AIR 31 in CMA, which itself speaks volumes about his dedication and depth of knowledge. With 21 plus degrees and certifications, including globally recognized qualifications like FRM from US, CFA from US, CPA from Ireland, and ACCA IFRS from UK, he brings a truly global perspective to financial reporting. He's currently serving as the vice president at one of the European banks, and he has extensive experience in IFRS-based accounting and reporting. His prior experience with Yes Bank in internal audit further strengthens his strong foundation in India's and regulatory frameworks. He is also a passionate educator, having delivered sessions to 50,000 plus professionals globally, and he has addressed more than 200 plus seminars, webinars, and certificate courses on different platforms, including ICAI, ICMAI, and various corporate institutions. His association with ICAI as a faculty and his contribution to the professional development initiatives make him a highly respected name in the fraternity. With such a rich blend of knowledge, experience, and academic excellence, I am sure today's session will be highly insightful and practically enriching for all of us. So, without taking much of the time, I now invite C. Harpreet Singh ji to take us through this important topic. So, over to you, sir.
Thank you so much, Accounting Standard Board, Rahul ji, and of course our learned moderator for the day, Yati ji, for inviting me and for such a wonderful introduction. And good afternoon, everyone. On this afternoon, we are all excited to see, to actually experience what is going to be the change that is going to happen to our one of the most favorite areas, most scrutinized areas, most relevant areas. It is an accounting standard. It is the area where everyone is focusing upon. It is the standard which is applicable to all the entities. And that is why this is the most important change that is going to happen, ladies and gentlemen. And that is why we have gathered. So I want you to please take out your notes. If you want to take the screenshot of my screen, that is also fine. But sir, what happens is the screenshots stay in our phones forever, but we never look at it. So I would like you to please write it down in your notepad. Have a lot of questions that might come to your mind, and then I am happy to answer all of them. Although we are having only 2 hours, and I know that time is going to fly very, very fast. But we are going to understand each and everything in great depth. And I assure you that after today's session, you are going to be filled with all the energy, all the enthusiasm, and all the knowledge that is required to implement this new change in the era of Indian accounting. And let me tell you, this is not only happening in India, it is happening worldwide. IFRS 18 is also going to be there in the world side by side, and we are also going to have India's 118 here in India implemented 1st April 2027. Okay, all right, sir. What it means if it applies on 1st April 2027, what I have to work upon, why on 29th of April 2026 we are talking about this. Because friends, let me tell you, we are not going early, we are still late. Why? Because there is going to be a lot of work that is going to happen, not only 1st April 2027, we'll have to work upon 1st April 2026 also for the comparables, and we are going to prepare some opening balance sheet, opening items for doing the proper reporting. And there has been a little discussion on what is going to change. Sir, we are going to deep dive all of that, and we are going to learn from there. Yes, we are having something in AS 118, and that is what we are going to do relating to Ind AS 118. So first of all, sir, what is the requirement of 118? Why we were having, sir, 115 and that was serving our purpose? Then why there was a requirement of such a new standard? Sir, we have talked about five-step model. Is the five-step model going to be the same or it is going to change? Sir, then we are having certain variable consideration. Q&A we might take at the end. Sir, there is going to be some significant financing cost. What is going to happen, sir? There is going to be some licenses, there is going to be some principal versus agent. These are the normal things that happen. Sir, is there any change in this area also? Sir, what is going to be impact on different industry? Is there going to be a huge impact on some industry and lesser impact on some of other industry? Sir, what are going to be the disclosures? What are going to be the management terms, MPM, which we are going to talk about? Sir, is that going to change? And what is going to be the PNL format? Is there going to be a new PNL format? And of course, we are going to take care of all of these things today. And we are going to talk about various complex scenarios also, and different things that need our urgent attention, right? So Are you all excited to go through this journey and take the next step in the field of financial reporting? Yes, I believe everyone is very, very excited. Now, sir, let us move on to the real things. Okay, all right. Sir, if I talk about my PNL, if I talk about my PNL, is it going to change? Yes, it is going to change. The format is going to change, and we are going to talk about it in greater detail. Sir, what is going to happen? Different portions are going to be very, very much detailed. Yes, the answer is yes, we are going to talk about that. Sir, what is going to be the industry-wise impact? Sir, there is going to be real estate on the top. Why it is on the top? There is banking, which is having the least impact, but still all the industries are having very high impacts. Sir, there's going to be MPM. Yes, what is going to change in MPM? We are going to talk about it and how it is going to change the entire landscape, because not only here in India, but worldwide also, people have financial statements separate and they are having their slides good looking and having new jargons which no one knows. And they are actually implementing and experimenting and inventing new jargons every day. Sir, what is going to happen to them? To those jargons, we are going to talk about all of these things, sir. Okay. Now, sir. Now, sir, let us move on to the first slide and let us focus on what has happened. Sir, earlier, there were certain milestones in 2014. Yes, IFRS 15 was there. In AS 115, we adopted at the same time. And worldwide also, IFRS 18 is issued and we have adopted in AS 118. Okay, sir, earlier we were having different situations and different things. Sir, there were inconsistent treatment across various industry, although the same facts were there. Same facts were there. So if you are having certain software company which is having a license and 2 crore rupees it has received, and it is for the licensing also, it is for the customization also, it is for the training also, maintenance also, and because of all of that, it was recognizing the entire 2 crore revenue on the day one, because it was very confident that it is going to be received and there is going to be zero uncertainty. But sir, that is not what is required, because revenue is not just a number, it is a value delivered thing. So it should be connected to the value that you are going to deliver at different times. Sir, at the point of time in earlier standard, there was no clear guidance on different things. There were some industry specific guidances which were there, and there were a lot of loopholes, and there was software industry, there were construction industry, there are other industries also where a lot of different things were happening in silos. Now, sir, each and everything is going to change, and each and everything is going to be streamlined. Okay, all right. Sir, it is not an Indian conversion, it is a global convergence that we are going to talk about. So we are going to focus on each and every. Now, if we talk about what is the core principle of IND-AS 180, right? So the core principle is that the revenue should be there, which depict the transfer of promised goods and services. So few things which are important, sir. Number one thing is it should be a transfer. Number two thing is some promise is done. Number three thing is some goods and services are delivered. Okay. Number four thing is, sir, there should be a consideration. There should be a consideration, okay, to which entity expects to be entitled in exchange for those goods and services. That this definition looks very simple, but there is a lot of detail which are imbibed in this 1-2 liner which is there, and I have highlighted certain words. Sir, what is the meaning of transfer? What is the meaning of promise? What are the goods and services? What is consideration? Is any transfer of goods without consideration not going to be revenue? Or what is going to happen in case of some revenue is in form of some kind? Okay, not exactly in the form of your money. Okay, what is going to be happen? Okay, sir, what is going to happen to our standard? It is going to be more principle based, because I have highlighted these 5-6 words. So we are going to focus on all these principles. Yes, definitely. And one by one, we are going to go through all of this, right? And for example, there are going to be no more industry specific rules, and there is going to be one framework that is going to fit all the sectors. Yes, whether it is a SaaS company, because there are a lot of software contracts which are there. Pharma companies, there are a lot of for example, there are some formulas which are sold, and which are sold with a condition that we are going to support throughout 10 years, 5 years, whatever. Or there is another condition when it is sold without any support. What is going to happen, and what is going to be the change in case of revenue recognition? Because now the revenue standard is very important from the very beginning, sir. We have seen Byju's case. We have seen a lot of cases in the past, and it is important. But it is now going to gain a lot more importance, a lot more disclosures, a lot more reporting, a lot of change in the P&L statement also. And everything is done to bring the transparency, to bring the clarity, because the problem is right now there was no clarity on a lot of things, and people were using it for their own advantage, and investors were not able to actually get the real picture in many cases. Now today, what I'm going to show you, you are going to see it very clearly what is going to happen. Now focus is the customer centric use. Okay, what is the customer perspective? When has the customer received what they paid for? So that value part is going to be the focus. Not I have received money, I have invoiced. No such thing like that, sir. Focus is going to be, has the value delivered to the customer? Then, and are you having irrevocable right? Are you having certainty? All of those things are going to be focused upon. Only then the revenue is going to go. Now you have booked the revenue, you have to classify, you have to present, you have to disclose in a proper manner. Sir, in accounting, what is the stages? Sir, first stage is recognition. Whether revenue has to be there, whether you don't need to have revenue. Number two, sir, then you are going to measure what should be the amount of the revenue. What is going to be that number? 200 crore, 300 crore, 5 crore, 1 lakh rupees. What is the amount? Number three, sir, presentation, how you are going to put it in your P&L, how you are going to put it in your balance sheet, how you are going to put it under different heading, subheading, or you are going to mix it in the other income, something like that. Okay. Number four thing is the disclosure. What are going to be the additional items, additional statements, additional reconciliations that you are going to do of revenue? So we are going to talk about all the stages, sir. We are going to cover it very comprehensively, so that no one no one knows better than you in this standard. And the implementation is going to be, of course, it is not easy, but it is going to be easier if we have all the knowledge with us, and we are geared up, we are ready for the implementation. Okay. Sir, there is a new P&L structure, of course, we know that, yes. And sir, we have heard that three categories are there, sir. Operating income, sir, investing income, sir, financing income. Now the same classification is going to happen in case of P&L also. Okay, sir. Sir, why this change? Why this change? You will get to know, sir. There was an utter need, and when you see the P&L with that clarity, you will be very happy. Sir, as a chartered accountant, you will be very happy, because what happens is, sir, we have to sign various financial statements. We sign on true and fair view. And sir, this standard is going to bring that true and fair view in reality. That is why it is very important. We are going to understand that also in a greater detail. Sir, now, of course, all the things that we are going to talk about now, sir, let us move on to the very important thing, sir. 5-step revenue model. This is one of the most important things in the revenue standard that we are having. Okay. Now, you have to think about the revenue of the client, of the biggest client that you are having. Are you actually following all of these principles? These are not the new ones, these are the old ones, but the details, a little bit of details are going to be more granular while I am going to discuss with you. So first of all, yes, are you using all of these principles? The answer is yes. So we are already doing it in AS 115. Sir, what we are doing? Sir, first of all, we are identifying the contract. Okay, what is the contract that we are having with the customer? Sir, we are actually identifying what are the performance obligations. Sir, now the question is what a contract means. Sir, it has to be written, it can be oral, it can be purchase order. What do you mean by a contract? It has to be notarized. What is the real understanding of the contract? Because now we will have to go to that recognition part also if we want to do the proper reporting, proper presentation, proper disclosure. Number two thing is, once you have seen the contract, now what is going to be the performance obligation? Sir, what is written? What I am going to deliver as a value to the customer, as a goods, as a services, as a support, what is going to be? Lot of different things, right? What is the promise that I have done in the contract? These are performance obligations. Number three, sir, what is the transaction price? What is the promise that customer has done to me? And this is one of the most important things. But let me tell you, sir, this is transaction price cannot do anything if we are not clear about the other four pieces. Because this transaction price has to be allocated to different performance obligation. If we are unable to find out the right performance obligations, then our accounting is going to be wrong. And there are cases where the accounting has changed by crores of rupees. And in case of Indian companies, hundreds of crores have changed because of this particular principle. Okay. And we are going to refresh this principle today. So then allocate to different POs, yes, definitely on the basis of SSP, standalone selling price. We are going to understand that. So fifth thing is recognize when the purchase order is satisfied, when the performance obligation is satisfied, and on the basis of the value that is delivered. It can be point in time, it can be over time. So step 1 to 3, what and how much. Step 4 is split, and step 5 is when we are going to recognize, right? All right. Now, sir, when we are talking about step 1, identify the contract with the customer, this becomes the most important thing because, sir, this is the starting point. A contract exists only when all, only and all. So both the conditions are very important. So these 5 criteria are important, simultaneously matter. Missing even one means no revenue. First of all, sir, it should be approved by both parties. Both parties. Sir, it can be in writing, it can be oral, it can be customary practice, but it has to be approved somewhere. It cannot be like that. That, sir, one party is thinking about something, both parties have to give the commitment. Sir, can it be a signed document? Yes, it should be a signed agreement. Sir, can it be simple purchase order, sir? Can it be an oral discussion? It can be an oral discussion, but the more signed document, the structured thing you are having, the easier work is going to happen. So what you can do is you can actually get the different things of historically what is happening and historically what has been the percentage rate of different payments, etc. So from that perspective, you are going to get a clarity that it is a normal curricular, normal customary practice of the customer or not. Number two, in your contract, the rights should be approved. Okay, the signature should be there. Okay, Harpreet has signed, sir. But what about the rights of different people? Different two parties are there. What are the rights, sir? What is the good? What is the service that is going to be transferred? What is the consideration? All of these things are going to be clearly identifiable, right? It should not be like, okay, we are going to give IT services, but the nature is to be determined later on. No, how can you recognize there's no contract? Sir, if it is not clear that I'm going to give you software license, then how can there be a revenue? There cannot be a revenue till the time you are not clear that you are having a contract, and you are going to have a contract only if the right of both the parties are. Number 3, payment terms are identifiable. Okay, you should have all the payment terms correctly identifiable, determinable. Okay, it can be a cost plus formula. Okay, can it be open-ended structure without a cap? Okay, so all of these things are possible, sir. In the past, there has been something like, okay, there is going to be market rate. We are going to recognize that later on. We are going to identify later on. Sir, one thing is you are able to understand that my revenue is going to be 100 crore, or you are going to identify, sir, it is going to be in a range. Till here, everything is good. If you are not able to identify the payment even as a range also, then sir, then you can't go ahead with the recognition of revenue. That is a clear thing. Okay. Sir, fourth thing is it should have commercial substance. Sir, round trip transactions are happening. Some company is paying money to some other company. That company is doing a purchase transaction. Then this money was given by this company only. This kind of a thing you have to identify. So it should have a commercial substance. You are doing it already, but it has to be granularly seen now. Okay. So why? Because sir, SEBI has penalized the companies in the past also for increasing the revenue by wrong means, and we have to be very, very careful because we are going to sign the financial statements on the basis of these different things. So then collectability of the consideration is probable. So the important thing is that, okay, you can recognize only if the collection is probable. Okay, if the connection is not probable, then in that case, sir, if you have received the amount also, then you have to recognize the liability that yes, I have to pay it back. It is a liability, it is not a revenue till the time everything is not clear. Okay, what do you mean by that, sir? It is clear or not clear? For example, you have done something where you have delivered some services on the basis of that there is going to be a profit, then we are going to get a percentage. There is going to be implementation, only then we are going to get a percentage of something. Okay, so in that case, if I have to deliver something, some construction, if everything is done on time, I'm going to get a bonus. If not done on time, I'm going to get a penalty. Now, sir, what is going to happen? What are you going to do? So what is the probability of bonus? What is the probability of penalty? Sir, then you have to see the history, you have to see the past, and on the basis of that, you have to recognize, okay, maybe in 1 out of 40 times you have received the revenue. Sir, 13 out of 9 out of 40 times you have received the penalty. Sir, now do the pro rata, do a probability calculation, weighted calculation, and then recognize the revenue. So any sales to distressed parties is not going to be collectible, let me tell you. And in that case, you are going to recognize revenue only and only if it is collectible. It is an important thing, sir. It is not unimportant. Sir, let us see an example. For example, sir, there is a builder in Gurugram. Sir, what is happening is there is a flat booking which is done. Okay, token is which is received. Project is under construction, right? In that case, sir, agreement is not yet registered. So you have not registered the agreement also. Sir, now there is developer track is what? Sir, there are 3 stalled projects already in NCR. What is going to happen? So first of all, we are going to see the different 5 criteria that we have talked about. Sir, is it approved? Is it approved? Yes, both have signed the booking form. Yes, absolutely. So there is a contract that one is going to buy, another is going to sell. Number 2 thing is, sir, rights are identified. What are going to be the things? Yes, it has told, okay, this is going to be 3 BHK. This is going to be the flat number. That's it. Everything is recognized properly. Okay. So third thing is payment terms. Yes, absolutely, sir. Milestone as defined. 1, 2, 3, 4, 5. We are going to pay. So fourth thing is commercial substance. Yes, of course, it's a genuine transaction. One person is coming to the builder and getting a flat book, etc., etc. Sir, fifth thing is collectibility. What is going to be the collectibility? Sir, collectability might be a problem. So there are already 3 stall projects. What is going to happen if this is not delivered? Number 1, sir, in this case, buyer home loan is also not done. Sir, what is going to happen if this person backs out tomorrow? What is going to happen? So in this case, how you are going to verify the collectability? In this case, collectability is not there. So it is going to be a big question mark. That is why, sir, on the real estate, it is having a huge impact. So one thing is this. Another thing is, of course, real estate is something where you promise right now and you deliver after 3 years, 2 years, 4 years, whatsoever. Sir, now you have received 80 lakhs. You have received 1 crore. Sir, is 1 crore going to be the revenue, or there's going to be something else? Sir, is it going to be recognized today, or is it going to be recognized at the third year? Sir, is it going to be 1 crore or something less than that? Because, sir, this 1 crore also includes interest. Okay. I will say again, sir, this 1 crore also includes interest. How, sir? Sir, you are receiving 1 CR today and you have delivery, you have performance obligation here. Sir, what do you think? Why this person is paying 1 CR to you? Why this person is paying 1 CR to you? Because, sir, this person is paying not only this 1 CR. Sir, if this person would have paid you 1 crore here versus 1 crore here, sir, the difference is the present value, sir. Ideally, this person is paying present value of some other revenue, some more revenue of maybe the revenue is 1.5 crore. And this person is paying a 1 crore right now. So yes, that is also going to be an important. Sir, now what I'm going to do with this 5 lakh? Let's not talk about 1 crore. Sir, this 5 lakh is going to be customer deposit liability. The revenue is going to be recognized only when, sir, all the 5 conditions are met. So till the time, if the collectibility is probable, not probable, then we are not going to recognize the revenue. One thing. Number 2 things. Sir, we have to identify the performance obligation. Okay, performance obligation is what? Sir, it is a promise to transfer a distinct good or service. What is a distinct good or service? Or maybe a bundle of distinct goods. So it cannot be a single thing also. It might be a bundle of things. Okay. So for example, why if you are having not distinct, okay, if you are having not distinct, if it is a bundle, or if you are having separate purchase orders, right, or performance obligations. So first of all, you are having some software and there is a mandatory customization which is needed to function. Can you break it in 2 parts? No, the answer is no. Sir, what is going to happen for mandatory customization needed for this software? If you are not going to sell the software, then this customization also no one is going to buy. Yes, absolutely, sir. What is the objective here? We have to identify in a bundle, sir, what are those 5 or 6 pieces that we have to do? Okay, sir. Sir, 1, 2, 3, 4, 5. So these are the separate pieces. How I'm going to identify, sir, these 5 performance obligations, sir? So basically, I am going to see, can you divide it normally? Can you ask a different vendor to do this kind of service? If it is not possible, then you are not going to divide it in 5. Maybe you say there are only 4 portions because these two cannot be segregated. These two are a single thing. Yes, sir, you have to identify different performance obligation. But what you have to do is, if it is inseparable because of the nature of your performance, nature of the product, nature of the service, then you are not going to segregated, virtually segregated falsely. You're not going to do it in your own word. If it is really possible, then you're going to do. So if, for example, in case of building construction, the materials are highly dependent. Some materials are highly dependent on each other. So in case of a franchise, say there is a mandatory setup which is there. So without that franchise purchaser, mandatory setup is not going to be sold separately. Someone is not going to buy the setup separately. So it is one and the same thing. So second thing is, if you are buying a license and there is an annual maintenance, so these can be separate also. You buy a license from someone, you do annual maintenance with someone else also, and this is possible. So you are getting the hardware and you are getting the installation, okay, from someone else. Yes, it is possible at all. Yes, definitely. Sir, you are having a product and you are having some extended warranty, which we normally see on Amazon, etc. When we, as a customer, also buy. So yes, sir, definitely these two things are available separately also, then you are going to distinct it as a separate PO. Why I am checking whether it is available separately or not? Because the idea is that I am going to see their individual prices, and on the basis of that, I am going to bifurcate my bigger price into these parts. Okay, so I'm going to divide it on some pro rata basis. Yes, that is why I'm identifying this. So how you are going to see, sir, is it capable of being distinct? Can the customer benefit, since the customer is the focal, from the separate products on its own or with other only? So one thing can't go without another. So if it is the case, then you are not going to separate it. Then it is a distinct thing within the contract. Is it the performance separately identifiable, or it is no, nothing is written about that. If nothing is written about, if it is written about software only, nothing is written about implementation, and somewhere it is implied or something like that, then it is only one contract. Okay. Sir, for example, there is a company and it is giving you license also. So there's a customization also, there's an implementation also, there's a training also, there is a annual maintenance service also. Let us see, sir. Let us see. For example, sir, there is a core banking software. Okay. So this banking software license, it's going to be forever. Number two thing is there is going to be customization that is going to happen for this software. Number three, sir, there is going to be an implementation and go live support for this software only. It is going to last 3 months. Number four thing is, since it is giving the software, then there is need of training also, because otherwise people will not be able to use this. Fifth thing is annual maintenance. Yes, it is going to have annual maintenance for year 2 and year 3 also. And for year 1, there's going to be 24/7 technical support available. So this is the thing that is written in the contract. Okay, sir, what I am going to do? Sir, can you separate different things? That analysis I am going. First of all, sir, license. Yes, it can be sold separately. Number two, customization. Sir, customization cannot be sold separately. How it can be sold separately? Because that license only is to be customized. Okay, sir, implementation. Yes, some you can get software for someone and you can hire someone else for the implementation. Sir, training. Yes, someone else can also do. Sir, for year 2, year 3 maintenance. Yes, this can also be done. Sir, support for year 1. Yes, this can also be given separately. But sir, this is going to be bundled with implementation. Why? Because the implementation itself is going to last for 3 months. And then this support, don't you think, sir, this and this are going to overlap? This and this are going to overlap. Yes, definitely. That is why we are going to bundle both of these things together. Okay. So what are going to be the POs? License plus customization. Okay. And at the go live only, it is going to be taken to your revenue. Number two, sir, implementation and year 1 support. Okay. So this is going to be 3 months this and 1 year this. So over the 15 months time, which is going to be spread. Okay. So this training 5 days. So whenever the training is going to complete, sir, you are going to recognize at that point of time. Number four thing is, sir, your maintenance for year 2, sir, you are going to do it over the time of second year. 12 months you are going to separate. Every month you are going to recognize. For year 3, similar. Third year, 12 months you are going to recognize. So you have to verify each SSP, standalone selling price later on, right? And if there are something which are not available, then you are going to see different market, etc. We are going to see that. So missing PO is the most common error in the IT sector audit. That is a thing. And whenever there is a related party transaction, we know already that it has to be done at arm's length SSP. So you can't do it at some, because in that case the amount is going to be different. All right, sir. We somewhere knew this already, and we have just strengthened our understanding. Now, third thing is, sir, you have to determine the transaction price. The third thing I'm going to do, sir, this transaction price is going to be what? Sir, it can be a variable consideration also, yes. Sir, there can be a SFC. This is a very common term which is going to be used. Sir, what is SFC? Significant financing component is going to be there. Yes. What is going to happen? Sir, non-cash consideration is going to be there. What is going to happen? And if customer is going to pay me, that is fine. But if I am also paying to the customer, then what is going to happen? So we are going to understand all of this. Sir, what are variable consideration? For example, you are having certain discount. For example, you are having certain debate. You are having certain penalty. You are having certain bonus. Sir, what is going to happen on these basis? Sir, you have to identify the expected value. Okay, how you are going to identify the expected value? Sir, you are going to say, okay, what is going to be the chances that bonus is going to be there? What is going to be the chances that penalty is going to be there? What is going to be the chance that discount is going to be there? All of these, sir, percentage, sir, 40% chance, this, 60% chance, this, sir, then what you are going to do? Sir, 40% chance, then revenue is 10 crore. So 60% chance the revenue is 100 crore. So 40% of 10, 4, 60% of 160, somewhere around 64 CR is going to be happening. So something like that you are going to do. Number two thing is, it is also possible that you are going to focus on the most likely amount. Okay, this is going to be the most likely thing that you are going to apply. Now, one thing is constraint. Okay, there are certain constraints which are there. For example, there are some things, it is saying there are some factors on which my revenue is dependent. Okay, but I am not having any control on those factors. Okay, for example, you are going to give the product after maybe 3 years. And in this 3 years, it is possible that the product, the particular material is going to be available in 6 months, in 7 months, in 8 months. Only then it is going to start, you are going to start the production. Or there can be such other circumstances if there is a very long resolution period of some issues, or there can be multiple outcomes. It's going to happen. Sir, in the past, such things have happened that there has been constraint of labor or something like that in the contract. Sir, if there is any constraint, any issue, you have to include the revenue only when it is highly probable that it is not going to reverse significantly. That is very important. So you have to not only, this is not only theory, this is not a statement, this is something which you are going to keep in your mind while you are going to see, okay, if this company is having variable revenue, this company is having a lot of different items which needs a very significant focus, then you are going to keep this statement in your mind. Okay, now, sir, next is significant financing component. So, if the payment timing is different from delivery, like I told you, you took the money today, and sir, after 3 years, you are going to give the flat. Then what is going to happen? If it is more than 12-month difference, sir, then you have to adjust for time value of money using the incremental borrowing rate. Sir, we have heard about this rate. Okay, where we have heard about this rate, you have to think. So we have to use that rate, and we are going to then make it two parts of the total amount. Sir, number one is the financing component. Number one is the interest. Number two is the real sale that we are going to do. And sir, why we are bifurcating it? Because of the change in the structure. Okay, there are itself going to be three parts, sir. This financing component is going to go to the financing part of the P&L. The sale is going to go to the first operating part of the P&L. That is why we are bifurcating it. All right, sir. Then, sir, what about the non-cash consideration? Okay, sir, you have to see what is that item and fair value at the contract time at the inception. That amount you are going to pay, not the fair value later on when item is delivered. No, fair value at the contract inception you are going to have. If, for example, it gives you some old machinery, etc., so at the date of contract, you have to value. Number four, sir, if the consideration is payable also to a customer. Okay, sir, there are some volume rebates that you are going to do. There are some listing fees that you are going to give to the customer, slotting fees that you are going to give. customer. Sir, should I recognize it as separate expense or should I reduce the total consideration from by this amount? Yes, sir, definitely, sir. You have to reduce the revenue unless it is received from customer for a distinct item. Okay, distinct items. No, sir. Otherwise, you have to reduce it. For this is the first principle, and we have talked about sir constraint. So three portions are done and dusted, and of course, this is an example on variable consideration. So yes, there is a bonus 5 crore if it is completed in 18 months. There is a penalty 2 crore. If beyond 20 months we are going to go. So this is a duration which is very much dependent on weather, etc. Also, sir, past projects are 70% delivered on time. What we are going to do, sir, 70% of 5 crore is going to be because bonus only going to be received 70% of the time as per the past history. The 30% of the time I'm going to have a 2 crore penalty, sir. What is going to be my net tax, sir? 3 crore plus 60.6 crore minus, sir, 2.9 is going to be the estimated consideration that we are going to have. Sir, fixed is 50, then variable, sir, most probable variable becomes what, sir? What expected value we have calculated. Sir, say this 2 crore, 52.9 crore is the revenue. So in this case, this is the total revenue. But what we are going to do, sir, we are in our case 60% percentage of completion is done, sir. So 31.2 crore we are going to recognize. And how we calculate the percentage of completion, we know already. So there can be input method, there can be output method. What is this? This is input method. And this choice also we have to make very judiciously. You have to check how the value is delivered. Okay, what do you mean by this, sir? For example, sir, you are having a major project. You are building, for example, a huge building you are making. And for example, sir, in the beginning, you are buying some material. Maybe you are buying all the building material, etc., etc. Big, huge expenditure. So there is going to be, sir, 200 crore of total expenditure. Sir, you are spending 80 crore rupees in the beginning because you are buying all the material in the beginning, right? And so this entire time is 5 years. Okay, 5 years. Sir, 200 crore is the total cost. Then 80 crore you have spent in the beginning. Yes, this is how the industry works. For example, in your case. Now, sir, what is going to happen? And the revenue is going to be 500 crore. For example, sir, what you are going to do? Are you going to do 500 multiplied by 80 multiplied by 200? Are you going to do that? Sir, what is going to be the outcome? What is going to be the outcome? Sir, maybe it is going to be some 200, yeah, some 40. Okay. Sir, let us see. Okay, fine. 200 crore you are going to have on the beginning. Okay. Sir, is it going to happen? Nothing is delivered right now. Nothing is delivered. 200 crore you are going to book as a revenue. The answer is no, no, and a big no. Why? Because, sir, you have to see how much value is delivered. Customer focus should be there. And this is going to give you a lot of observations, a lot of discussion, boardroom discussion that you are going to do because of this point. Sir, what is the value delivered? See, value delivered right now is 0. So you have to check whether you have to use input method or you have to use output method. Not like, okay, my cost is incurred and then we are going to book a revenue. Very important. All right, sir. What is the significant financing component, sir? Yes, what is significant financing component? Let us do that. Now, payment timing is different from the goods and services trust. Okay, so definitely I have given you example. Sir, for example, in real estate, you are paying advance and there is a delayed possession, for example, or normally also the possession is later. Sir, in case of long-term construction contracts, sir, there are milestone-based payment which are there. Okay, milestone-based payment, but there can also be a significant difference between the things done and the payments which are done. Okay, in case of export, for example, sir, there is a 90 to 180 day credit. So what is going to be the treatment in that case? Or if there is going to be business to business this software services, sir, there is multi-year upfront subscription payments which are done, then what is going to happen? In my example, sir, customer is paying 1 lakh rupees right now and is getting machinery in 2 years. Sir, now what is going to happen, sir? 1 lakh is the total revenue. 1 lakh is the total revenue which is due here. Okay. Sir, that means, sir, it is paying you 1 lakh rupees now. Okay. 1 lakh rupees now. That means, sir, this 1 lakh not only includes your sales portion, but also your finance portion, interest also. Maybe, sir, this revenue is 82,000 rupees. This revenue is 82,000 rupees. But the rest of the thing, since you are going to deliver the value later on, the rest of the thing is going to be your interest. And that is why the financing income is going to also be recognized over 2 years, that is 17,000 rupees. Your real revenue is only 82,000 rupees because, sir, then you, after 2 years, you are going to deliver the machinery. So just think about it, sir, 1 lakh rupees at that point of time are 82,000 rupees as of today. Right? Absolutely, sir. Okay. And this financing income would go to maybe investing activity or financing activity, we will see. But it is not going to be the revenue from operation 100%, sir. Now, what is going to happen in case of the accounting entry? Sir, bank account 1 lakh. Sir, revenue from operation 82,000. Okay, all right, sir. What is the contract liability which is going to be there, sir? This is going to be contract liability, and this is going to go to finance income over the time it is going to go. All right. In that case, sir, now think about all those customers, all those clients of yours, which is going to have a significant financing component impact on their revenue. Because, sir, then people were talking about this, our operating revenue has increased by this. Sir, it is not going to go to the operating revenue. No, now it is going to be part of either of investing or of financing. And sir, wherever there was a bragging about the operating revenue increasing, sir, it is going to change very, very significantly, let me tell you, because of these changes, sir. Now, sir, next thing is allocate the transaction price of it. Sir, we are going to allocate the transaction price step 3 and into step 2. Okay. Step 4 is, sir, transaction price we identified. Sir, the performance obligation we identified. Sir, on what basis you are going to classify the transaction price to each of the performance obligation. So in that case, what you are going to do, you are going to actually see whether there are observable SSPs. Okay, you can see, go in the market and you can see that you are selling yourself these product as bundle and these product as separate also. You yourself, no one else actually. So this is the best evidence. You are selling it for maybe 400 together, but 100 500 separately. This is most reliable and this is preferred. For example, you are having already software separated and you are having this price list also. The second thing is market assessment. You are going to the market, you are going to evaluate the market price of similar goods and services, and you are going to adjust that for your own cost and margin profile. Okay, you take margin 20%, someone else is taking margin 10% only, then you are going to change market price slightly for that. So if you're not having any standalone, then it is good. Number 3, sir, if, for example, you are not able to find any market, anything like that for this, then you're also allowed to do the cost plus margin. But in that case, sir, you have to do a very good documentation. So as an accountant or as an auditor, you have to verify that good documentation that needs to be there. Okay, all right, sir. And there is one more approach, sir. There is a residual approach also. Residual means, sir, there is a bundle in 400, and sir, for example, there is going to be different components, sir. You know, 100 is this, 100 is this, 100 and 20 is this. Sir, fourth portion I'm not able to justify what is going to, or I'm not able to do observable, not able to do market assessment, not able to do cost also. So then residual is going to be this. Okay. So whatever is not divided, then fourth portion is going to be the residual. This is the last resort when nothing is possible and your SSP, the standalone price, are highly variable or uncertain. Okay. And your performance obligation is at the lowest or highest end. Matlab, it should not be the main one. Okay. You can't do it for main thing. You can do it for some other kind of a service, which is very, very ancillary, not the main one. All right. Then this is going to be the formula. That is fine. But sir, what is going to happen if, for example, I am having 400, sir? Okay. For example, this is 100. This is 200. This is then 120. Okay. So if I go to check for the fourth one, what is going to be the value? So it is going to be minus 20. Then sir, what is going to be? What I'm going to do for that? For minus 20, what I'm going to do that? Sir, am I going to recognize revenue negatively? In that case, sir, what you are going to say, you are going to divide this minus 20 proportionately in these portions. Okay. Then fourth portion is not going to be recognized at all. Yes, that is going to be the thing. All right. Now, let us see the geo case. Okay, all right, sir. In this geo case, customer is paying 499 per month for 12 months. All right, sir. Now, sir, what we are going to have, this is a smartphone which you are giving in this 499. You are giving 12 month service also. Okay. And if I see smartphone standalone is 22,000 rupees. Okay. Service plan standalone is 299 rupees per month. Because of this smartphone, additionally, you are increasing this per month amount to this. That means you should not do 499 per month straight to the P&L. Absolutely, you should not do. What you are going to do, you are going to divide it in different portions. How you are going to do that? Sir, what is the total SSP standalone price? Sir, it is 22,000. It is 3588. Absolutely, sir. Total becomes 2588. Yes. And the percentage, what is the percentage? Sir, 86% is 14%. That means majority of revenue, 5149, is going to be recognized on day one because you have delivered value to the customer. Yes, handset is delivered to the customer. Handset. Then per month for 12 months, because the service plan is there, this 839 is going to be divided into 70 rupees per month, small amounts. And what is going to be the counting entry? Cash, yes. Revenue, recognized. So this is a contract liability. This is a liability that you have to do. You have to deliver value every month. And every month, so 70 rupees with revenue, you are going to do this. Okay. Now this is going to change the revenue and EBITDA margin, of course, for different telecom companies. If this thing is implementing and this thing in 115, it's similar. Okay. So fifth thing is when to recognize. Right now I am going to recognize, and over the time I'm going to recognize. This is already covered in different portions, but I'm just going to right now when you're going to do it. Sir, if there is a legal title which you have obtained, okay, all right. Sir, if for example something is on the paper, the physical possession is given, the risk and rewards are transferred, unconditional right that payment is going to be there, and there is an acceptance from the customer, sir, then you are going to recognize real time in time only. Examples are retail sale, of course. You are doing some retail sale. You are doing free on board FOB exports. There is a perpetual software license. Okay, there is a completed flat handover that you are going to do. So in that case, it is going to be point in time. Sir, what is over time? In this case, sir, there is a simultaneous receiving of benefit. The benefit is being received simultaneously in case of, for example, in case of service contracts, sir, every day, the customer, Who is available, sir? The organization or the team is available, and as and when the call happens, sir, that team is always available for any of the issues. Or you are going to create or enhance the asset, whatever customer is having. Then you are going to recognize over time. For example, sir, what is going to happen? You have got a contract. Okay. This contract is what? So there's a land of the customer. All right. You have got a contract that, okay, on this land, I'm going to build a house. Okay. This is a simple contract. Now, sir, this is going to be in such a way that even one brick you are going to put, even one brick you are going to put, you are constantly adding value to an item which customer controls. Yes. In that case, sir, it is going to be over the time, and it is not going to be point in time. On day one, it's not going to be there. Sir, no alternative use and right to payment for the work done to date is there, then what you are going to be doing, you are going to recommend overtime. For example, sir, there is a cleaning service which is there. So every day, such cleaning, etc., is happening. For example, of the whole of the office, of the whatever your store, etc., then that cleaning service is going to be recognized as over the time. All right. So then there is a construction, there is a SaaS, okay, software as a service subscription, where you have given 1 year license, 2 year license, 3 year license. That license usage is happening every day. So it is over the time. There is an annual maintenance contract. Yes, in these cases, they are going to do overtime. Okay. And there can be input method also, output method also, or straight line. Straight line is going to be my last resort, sir. Only if there is an equal benefit which is delivered each period. So this is going to be the last thing which I'm going to focus upon. Possibly I'm going to focus upon the input method. I'm going to focus upon the output method. Yes, and only on that basis I'm going to recognize different items. Now, for example, there is a project cost 500 crore. There is a sale price 700 crore. And now there are certain milestones on the basis of that customer is going to deliver or customer is going to make the payment. Now, sir, first of all, the agreement is registered. Yes, so in that case, sir, the contract is there. Now, in these cases, builder cannot sell unit to any other buyer because of the RERA and the contract requirements. All right, sir. That means there is no alternate use, absolute no alternate use, cannot be sold to any other buyer. Okay, sir. In that case, customer can also mortgage under construction property. Yes, on the basis of that, it's going to receive loan, etc. whatsoever. Sir, right to payment. Yes, builder can definitely recover cost, etc., margin, etc. Even if the customer cancelled it, which is upheld by court. So basically, in that case, sir, revenue certainty is there. And in first year, 40% is going to complete, and the cost is 200 crore, which is incurred. So I'm going to say, okay, what is the percentage completion? Is 40% because out of 500 crore, I have completed 200 crore expense and 40% is done. So revenue is also going to be 40% of 700. So 218 crore is going to be recognized. So contract asset 280 going to go to revenue from operation, and whenever the money is going to receive, sir, bank account debit to contract assets. So that is going to happen later on in the future. All right, sir. And then whatever is the cost, sir, yes, this is also going to be maybe set off following the contract asset or work in progress, and the payable is already there, or you have done the payment already. All right, this is good. Sir, if we talk about license, this is very interesting. Okay. Sir, in case of license, there is a right to access versus right to use. Oh my God. So there is a lot of complexity that we are dealing today. What is meant by right to use? What is meant by right to access? Sir, if you have given license of a software and you are not going to work further on it, You have just delivered it today, and after today, you are saying, Tata, bye bye, we don't know you. We have given you license, this software in this CD or this pen drive, and we don't know you now. Okay, you use it forever, for whole life. We are not going to look at your software again. So that was the older model of the software. So the newer model is now over time, sir, over time. Okay. Sir, you have to recognize then at the grant date immediately. So full value, sir, 50 crore software, full value you have given, sir, it's a product, it's not a service, right? So perpetual software license, there is a movie rights for a team. So you just play it forever, sir. Surya Vansham, you play forever, forever and ever. Okay. Patent license with no ongoing support, sir. I have given you patent. I have developed a medicine, sir, maybe for some corona or some other disease, and then you just use it. You make any medicine. I don't want. I'm not going to check. I'm not going to support you over the time, and we have to now make the medicines. That's it. So this is at the grant date. Whenever you get, you say give that license, the patent, etc., the revenue is. Now the second thing is, sir, I am going to be focusing on, it's an ongoing activity which is going to significantly affect the value which we are going to have, the customer is going to. We are updating our license on the regular basis, sir. And for 10 years, for 20 years, we are going to update our licenses. I'm going to say, sir, I will be, I'm giving you the patent, but at the same time, sir, I am on that journey with you. Sir, I'm going to test, I'm going to see, I'm going to update this medicine also based on the different surveys that show, right? So customer benefit is changing throughout the license period, sir. Over the time, the benefits are also increasing over the time because different features, new features are added. Customer is exposed to positive or negative effect, so you have to recognize over time. For example, so it's a franchise licensing. So whatsoever is going to happen on all the franchises, the design is going to change, the product is going to change, the service is going to change, the new teacher is going to come and teach. For example, ongoing SaaS with the continuous updates. Absolutely, sir. Celebrity endorsement. Okay, for a time period it is done. So then you are going to do that. Sir, in case of OTT or Bollywood, sir, they are going to have, okay, 5 crore minimum guarantee and 2% of the subscription, and it is based on the sale, it is over the time. Okay, then you have to recognize only then when the sale is happened and the PO, performance obligation relating to license, also has been satisfied. There's no need to estimate, no need to front load the royalty. Don't think about that royalty is going to be received. Let me do on expected value basis. No, sir, as and when the sale is going to happen, then you are going to. Yes. 100%. All right. Now, sir, there is one more thing, sir. Principal versus agent. We know it already, but still, I can cover it. Right, sir. There's a very famous Zomato and Swiggy thing. So in case of Zomato, yes, you are selling for 400, but you are recognizing only 100 revenue. Why? Because you don't have any control over the food. You don't control the price. You don't control uh, different things. You are just being an agent, picking the parcel from one place to another. So you are not controlling food quality. Nothing is in your hands. You are just fulfilling the promise, delivering. No inventory risk is there. There is no discretion in the selling price. You don't have any credit risk. So then if all the things are not there, then you are working as an agent, just recognize commissions. But if all of these you are taking care of, your principal recognize the full revenue. Now, what is going to happen? Sir, a lot of different ratios are there. Sir, there is going to be, sir, revenue, various ratios, sir, turnover, various turnover ratios are there, sir. There are going to be margins, gross profit margin, net profit margin. All of those are going to change because of the incorrect agent and principal classification. So we have to be very focused on this. Now, sir, वो घड़ी आ ही गई जिसका मुझे था इंतजार. I was waiting for this new PNL format. Yes, sir, what is the new PNL format? Please let Let me understand. Please tell us, sir. Okay. Sir, the new PNL format, if you are going to talk about, is as per 118. It mandate. You don't have a choice. Can't say, I'm not going to apply, sir. It is a mandate that you're going to have three categories in the PNL. Okay, in the statement of PNL, you are going to have three categories. Sir, to whom it is going to apply? Is it going to apply to every company, sir? Every company in India is going to apply? No, sir. Whatever is the requirement of Ind AS application, sir. Whatever is the application on Ind AS, sir. Sir, Ind AS is going to apply to the companies which are 500 crore, yes. 250 crore turnover, yes. Listed, yes. Sir, banking, no. So wherever India is going to apply, sir, 118 is going to apply. Simple, as simple as that, very, very simple. Now, sir, you are going to divide your PNL into three parts: operating, investing, and financing activities. These three things. Okay, all right. Now, sir, what is meant by these three things? Sir, operating is going to be my focus. Sir, the revenue from operation I'm going to have full focus on this. All now the other operating income I'm going to have, but what is going to be not there in this other operating income, sir? Dividend can't be part of this. Sir, any investment disposal, you have sold some shares, you have sold some bonds, etc. No, that cannot be part of this other income. Interest on investment holding. So if you are having some interest on some investment, that is not going to be a part of it. All right. Sir, if there is an interest earned on FD, etc., so that is also not going to be a part of. Okay, that is going to be a major change. What about the COGS? Sir, yes, it should be operating. Employee cost, operating. Depreciation, operating. And there are some other expenses also. Sir, what are we talking about? What we are going to put in here? Okay. Sir, for example, sir, you have revenue. Okay, there are different revenue, other operating revenue, but it should be operating. There is inventories, yes. Raw material use, yes. Employee benefit, yes. Depreciation, yes. Other operating, only operating, sir. You are not going to include any other expenses. For example, income tax, not you are going to put there. You are not putting even now also. Sir, then what is going to change? This investing and financing activity. You are going to separate. Sir, if you are receiving dividends, if you are receiving different sale purchase income, you are not going to put. Sir, if there is a loss on some investment, some fair value changes on investment, no, don't put it in the normal PNL, operating PNL, separate it. So there is going to be, if impairment of the investment, so that is what also you don't have to include in the investing activity. Okay. So this is operating profit that you have from the operating category. After these two things, these three, four things, you are going to have operating profit. And this is going to be EBIT equivalent. Okay. This is going to be the core business income that you are going to tell anyone. All right. For example, for Tata Steel, sir, steel revenue is going to be the focus. Wages, depreciation, amortization is going to focus. This is the traditional income statement for any manufacturing or service entity. Only thing is that is going to change is the inclusion of investing and financing income and expense. So that cannot be part of the main PNL, operating PNL. Although why I am saying it's a main PNL, because sir, everyone's focus is this. As a business, I am investing in Tata not because of the huge interest income that is having. I'm investing in TCS, and especially the focus, the impact is going to be on these companies. That I'm not investing in TCS because it has a huge 50,000 crore cash, and which is it is investing everywhere and it is earning huge income, sir. But my focus is on the S software, sir. What about the software revenue? Why you are telling me the revenue of some investment, etc., and mixing it with the revenue, and no one is able to understand what is the revenue from the real business? That is going to be bringing more transparency. All right, sir. What about the investing category? Yes, investing is dividend, investment disposal, some purchase, sale, gain, loss. All the things are going to be here. Sir, if you have received dividend from Tata, different subsidiary, Tata Sons, yeah, that is of main income. Sir, in case of Tata Motors, sir, it has some, for example, interest on FD and mutual fund investments. Okay, all right, sir. What is going to be the financing activity? Sir, on the short-term items, on the cash and cash equivalents, if there is any interest income, it is going to go to the financing activity. If there is going to be any interest income on the long-term items, sir, it is going to go to the investing activity. So that bifurcation is clear, sir. Now, sir, further, if we are paying some interest, that is going to come in financing. And then when there is a debt issuance and I'm paying interest on that debt issuance, bond, etc., so that is also going to come here. In case of Ind AS 116, lease interest, sir, if you remember, so there is a standard 116 also. We don't only need to remember 118, but also all the other 40, 41 standards also we need to remember, sir. What happens, sir? There is a concept of ROULL. Sir, my lease liability is going to increase by the interest. And it's going to decrease by the rent payments. If you remember. So that lease interest is going to go to financing category now. Yes. All right. Sir, what is the impact? Different EPS, different key ratios, etc., are going to change, and all the equity analysts, they need to actually rebase their models. They might have everything aligned to the company's profit and loss, etc. But now it's going to change, sir. And where the companies are having large treasury income, there is a holding company or the cash-rich tech companies, then you are going to see, sir, the operating profit is going to change very significantly. And of course, the audit committee, auditors, etc., need to focus on all of these things very quickly. And I'm going to tell you, it's a change which is not going to happen sometime in 2027. It has to happen now. Right now, you need to start. All right. Next important thing is, and the focus thing is, sir, this MPM. What is MPM, sir? Sir, there are investor calls. There are results which are declared. There are very good and big presentations which are made, sir, which are not your financial statements. Sir, NDS is saying, prepare the financial statements. So that financial statement is prepared. But sir, apart from that financial statement, a very beautiful slide is made. A very beautiful slide deck is made. And there they have, the companies have their own terminologies. Adjusted EBIT, adjusted operating profit. Sir, these different terminologies they have invented over the time. Now, the problem is, sir, if you are showing these kind of terminologies, number one thing is, sir, what about the comparability with the different companies in the same category? Okay, that comparability goes off in your real investor also. Number two thing is, sir, now people, if I want to understand, sir, they have talked about what is adjusted EBIT. Somewhere it might have given a small formula or something like that, but people are not able to understand its adjusted EBIT is equal to what of company B, what of TCS and Infosys, for example, what of adjusted EBIT equivalent of TCS is there in Infosys, because so the financial statement is fine. That is the proper format that in which it's going to be prepared. You can compare this to this. But sir, everywhere the investors are talking about in the calls, everywhere there is a discussion about not these two items, sir, some other item. There, two, three things are added and told this is important. This is important. Now, how, as an investor, you are going to understand whether this is a good thing, whether this is a bad thing, what has happened in case of other entities or other companies. So that was a problem which was there. Now, sir, what to do? What to do about it? Now, what to do about it? Okay, all right. So let me follow it. The subtitles have started coming. I was trying to find something else, but that is okay, sir. No problem. Now, what to do about it? That's all. Where I was. Yeah. Okay. Now, what to do about it, sir? MPM is the subtotal of a income and expense. Okay. Subtotal of income and expenses communicated publicly. Publicly, I'm talking about it, and not specified by NDS. There are some new terminologies which are in practice, maybe in the industry, which are used by some specific company, or which is used by a specific company in a particular result. Maybe in Q1 2025, Q1, Q4 2025, they have done that terminology used, not earlier and maybe not later on. Then, sir, these were the things which were there, and this is used to convey the management view of performance. Now, this should also be disclosed and reconciled in the financial statement note. So, whatever statement you are going to give, whatever terminology you are going to use, sir, it is going to be reconciled back to any item which is there in your financials. And this reconciliation should be part of notes to accounts. Now, two things are there, sir. As an accountant, as a chartered accountant, as an auditor, my work is also increased, right? Because those slides, the slide decks were out of my focus, out of my audit purview, because that was not something which I was controlling at point of time. Now I am having that also under my purview. And secondly, sir, my financial statement notes are going to be larger. Okay. And third thing is that there is going to be a huge transparency which is going to be given to the investors or to the street. And this is not happening in India also, in worldwide, everywhere. So that is the real situation which is happening, and that is why the IFRS 18 and Ind AS 118 is there. What are the common MPM in Indian corporates? Sir, EBITDA. There is an adjusted EBIT. Okay, there is an underlying profit. There is a net revenue. There is an organic revenue growth. What are all these? So now, what are the required disclosure for each MPM? For each MPM, you are the term that you are using. Sir, what are going to happen? Sir, you should label it first of all. You should clearly describe. Okay, this means this means this. What is the acronym? What is not only the full form, but what it actually means. Okay. A reason should also be given, sir, why it provide useful information. Why? Why? Sir, there should be a reconciliation also to the closest Ind AS subtotal in the P&L. Sir, whatever is the subtotal on that item, you should give. Sir, what is the tax effect of each adjusting item? You are going to tell that also, because you are taking maybe tax adjusted profit, maybe profit before tax, you are adding some figures without tax. So whatever is going to happen, sir, the tax effect also you have to tell. And fifth important thing is, sir, it should be consistent year on year. And if not consistent, then you have to explain if there is any change. This is a new requirement that you are going to have a compliance with, and it's a very major requirement. Now, for example, this is an example reconciliation sheet. You are talking about adjusted EBITDA. You are talking about EBITDA. What does it mean, sir? For example, can you see, sir, your profit before tax, which was in Ind AS, it was 28,500 crore, but you added some finance cost, added back some finance cost. Okay, you added back some depreciation, etc. You have deducted the net investing income, etc. And then you said 30,000 is our EBITDA. Now, proper reconciliation should also be given, right? Now, sir, you are adding the restructuring charges which were added, which were deducted earlier, and you are saying now my revenue is 30,000 crore instead of 28,500 crore. So, sir, 2,000 crore revenue increase, how it is happening, right? So that reconciliation also should be given properly. Now you are able to see each and every figure, or okay, what it is adding, what it is deducting. Now you have full clarity as a investor, as a consumer, but as a chartered accountant, sir, my responsibility has increased. Okay. Next, key point for audit committees are EBITDA and other non-GAAP measure are no longer free communication tools. You don't invent anything and you don't just go to the street and say, include it in your slide and just talk about it. You have to have a proper the requirement fulfilled. Number two thing is you have to have a proper reconciliation. Yes, and it should be very, very consistent. So it should be formally defined, disclosed, reconciled. Non-compliance with this new requirement, it will be a qualification finding, sir. Absolutely. I think we are all on the same page. All right. For example, sir, in EdTech, Byju's, who won't have heard about the Byju's case, right? Absolutely. Sir, if it was doing a bundle sale, sir, this 1,20,000, sir, it is giving the video, 2-year video. It is doing the live doubt solving sessions also. It is giving you physical study material also. It is giving you a mock test also. And it is giving you monthly mentoring sessions also. So everything is decided. Now, something, the things that we, as a customer, we see the features of different things, or maybe things that they are delivering in this much money, sir. For a chartered accountant, for an accountant, for an accounting team, this becomes a segregation, and in this much detail it has to be segregated. Okay, so different PO performance obligation we are going to identify. Sir, what is going to be the video access time period? Is it going to be overtime monthly? We are going to recognize. Sir, what about the physical material? We have delivered it, done and dusted, sir. Recognize at that point of time and delivery is done. Third thing is, sir, different mock test. Mock test is going to happen every time. Every test is going to be done, sir. Then it is going to happen. Mentoring, sir, over the 24 months you are going to do, every month you are going to do number of sessions. Sir, doubt solving. Sir, if there is a doubt solving that is going to happen, that is going to, there are some doubts which are going to come. So that is going to be on the list of. Okay, all right. Now, sir, in this case, the Byju's were recognizing all the amount 120 in the beginning only, right? And the student was enrolled and student was taking a loan. So in case the student cancel the subscription, so then the refund liability comes over, and then, sir, what is going to be the loan happening to the loan, because the loan is going to be embedded in the sale, and in this case I need to have my contract liability increased. This was massively understated in the case of Byju's. We know, sir, revenue, in if you are learning about revenue standard and not learning about Byju's case, that can't happen at all. Can't happen at all. So yes, this is an important thing, sir. Of course, the auditors resigned from that, and they said there is a major issue. 2 years, for 2 years, sir, the financial statements were not filed over. That was a huge thing, sir, which happened, and there were big audit red flags. So we know that if this standard can result in this kind of outcome also, where the company actually the prices etc crashed like anything, so customers or consumers don't know where they are gone, teachers etc, the entire infrastructure, sir, is devastated. Not only that, the regulatory investigations on the founders, on the family members etc. So not only that, the auditors resigned at that point in time, but everyone is part of that cycle now. So it is very, very important, especially when this is India, this is not applicable on smaller entities. So the responsibility is even bigger. And when you are talking about the listed companies, the thing is not very, very easy. I will talk about it. So the entire ERP, etc., also need to be revamped, because you need to have all those touch points, data points also in your ERP, in your software, in your report generation utility. And because of that, so that is why it is going to take some lot of time and assessment etc, and the right time to take action is today, right now. All right. Further, sir, we have talked about, sir, recognition. We have talked about measurement. Sir, we have talked about the presentation also. Now let us talk about the disclosure. What needs to be written? What needs to be disclosed in case of your revenue? Yeah, sir. First of all, disclosures enable user to understand what is the nature, what is the amount, what is the timing, and if there is any uncertainty or not. Now, sir, what we are going to do? First of all, we are going to disaggregate the revenue. Yes, disaggregate means, sir, you were talking about the aggregation under different headings. Yes, absolutely, sir. We talked about the operating category, we talked about the investing category, we talked about the financing category. This was the aggregation of different items under different categories. I am now talking about the disaggregation. Disaggregation. Okay, disaggregation means, sir, we have understood the segment reporting. Now, this aggregation is also going to be happening by various categories and on various economic factors. It is on the product or service type. It is on the geography type. It is on the different markets or customer type. Sir, it can be on the contract duration also, short term or long term. Okay, timing, point in time versus over the time, different sales channel. Maybe there is a direct sales or maybe there is a distribution. What is going to happen? Then, sir, the remaining performance obligation. All right. Sir, what is going to be disclosed is in all the cases, sir, the companies have to mention what are the performance obligations which are remaining as on my year end. Because there are some contracts which are for more than 1 year. Then you are going to disclose what is the full price, what is the allocation out of that to unsatisfied performance obligation. So this is my contract liability actually at the end of the year. And when the entity is going to recognize, sir, then you are going to mention maybe in a table format, etc., that yes, this is going to recognize in this period, this period, this period, and so on. But it is not required for the contract which is completing within 12 months, or there are some sales or usage based things. So of course, when the usage is going to happen, when the sale is going to happen, it is going to be automatically recognized. Then you have to mention the contract balances also. What is the contract asset? Because this is going to be receivable if the condition is met. Number two, contract liabilities, sir. The advances, the loyalty points, etc. If it is there. For example, sir, there is a company which is managing having a loyalty program. There is a hotel, hospitality industry. Sir, the loyalty points it is going to give, it is going to give, it is going to give, and they are going to redeem maybe later on. So then you have to have a system also for that, okay, which is going to give you the reports with that historically what has happened and what how this different loyalty points are actually utilized so that you can have the real correct contract liabilities in your books because of that. Then you are having the trade receivable. Okay, so different receivables that are going to come in unconditionally. Okay, so if there is a contract asset, contract liability, that is a separate thing, but this trade receivables are it's 100% receivable. There is no if, no but. Yes, because in these cases, every situation is satisfied, every condition is satisfied. So all the balances you are going to disclose for different items, and also then you are going to show the revenue that is recognized in the opening contract liability. So that also needs to be mentioned. Now, next thing is there are significant judgments which entity would have taken. So disclose all the judgments. So all the things that we talked about, the 5 steps, etc. So every judgment you have to talk and mention as part of notes to accounts of and of your financial statements. So you have to disclose the judgments made, different performance obligation identifications, and how these tests, etc., are done. So there are a lot of policies and procedures which is part of my financial statements even now. So how different hedge accounting is done, how the financial instruments is value, the FVTPL, all the things are right now also disclosed. But this also has to be disclosed properly as part of notes to accounts. It is part of the deliverable as per different Ind AS, and it's a statutory requirement now. Okay. So purchase how performance obligation you are going to identify. Second thing is what is the method which is used to estimate the standalone selling price. On the basis of that, you are going to bifurcate. What is the method used in POC, sir? Percentage of completion. How you are going to determine is going to be input, output. What is going to be the way? Sir, what is going to be the way of recognizing the variable consideration recognition? And let me tell you, it's going to be different in the case of different companies. So it's not going to be same in all the companies, going to be very different. Okay. So in your case, what is the variable consideration which are there? And every year you have to see that, okay, what are the new requirements which are there? And what are the constraints which you have applied, which are visible in your case, and what is the rationale in that? And very important, you have to disclose all the MPM definition and reconciliation. That's a major thing that. So basically, yes, sir, your disclosure is also going to change. Your presentation is going to change. And whether you believe or not, sir, on the basis of that, sir, your recognition and measurement has to update first of all. It has to be accurate first of all for giving all these information, because otherwise what you would say, if something is happening not on the basis of proper formula, how can you write it in your notebooks? All right. Now, what are the common errors which can happen, sir? Not identifying all PO, sir. If something is left out, sir, often something is missed, then, sir, it is going to be having a huge impact on your PN, on your different presentation and disclosure. The second thing is, if you ignore the variable consideration, you say, sir, I am going to book the full value upfront without applying the constraint, without applying any of the uncertainties. Okay, there are some penalty clauses. Yes, there are definitely in case of construction contracts, bridges, etc., or any other contracts. So there are penalty clauses which are there, and these are high risk. So don't need to include the variable consideration. Number three, if you are misclassifying input or output methods, sir, initially you spend 80 crore and full value is 200 crore, but no value is delivered till now. So only spend is done, so you can't recognize the revenue pro rata on the basis of spending only. So that is a very important thing. Sir, omitting SFC adjustment. Okay, so if you are having significant financial financing components, you have to actually don't ignore it, especially in case of multi-year advance payment. Sir, more than 12 months, if anything is there, sir, you have to think about and recognize SFC. So financing component separate and your operating income separate. Wrong P&L category. Yes, sir, it has not to be the wrong P&L categories are FD interest, the mutual fund return, etc., etc. Sir, we should go to the investing activity, or small for short term, it is going to go to the financing activity, but it is not going to go to other income in operating. Okay. So then contract modification, if there is a contract more than 10% contract is changed, so then you have to treat it as a modification. Okay, sir, it's a new contract or it's a modification, then you have to determine, and it might turn out if it is more than 10%, it is going to be a new contract. Sir, if you are missing MPM disclosure, that is also a possibility which might happen in case of your different presentations, etc. So you have to be very, very careful that you don't miss anything, any statement, any term that you are using. Maybe EBITDA, maybe some adjusted margin or something. Anything that is you are using as a new term, which is not in Ind AS anywhere. So you have to define it. So, for example, what has happened if a company is having, for example, there are 100 branches, these 100 branches are taking the contract separately, they are maintaining all the information, etc. Now, sir, as a statutory auditor, you have all the work, which is very, very difficult. Now, you have to actually go to the various branches or you have to ask for the information because nothing is maintained at a central level. Sir, now, what you have to do, sir, some changes in ERP, etc., have to be done, especially in multi-location business, so that, sir, this principle is going to be applied at a central level. So it is very, very important that we have, and it's not a small work, let me tell you, it's going to be a huge work because all the data points you are going to have by making changes in your ERP, etc. Also. Now, sir, these things are there and it is going to have an impact on different industries. Sir, banking NBFC, okay, not going to be a lot of impact because in EIR, sir, if you have studied in AS 109 or applying it, you already know what EIR means, right? So the rate that you are going to apply, effective interest rate that you're going to apply. So it is already taking care of all that item financing component, etc. So least impact on banking or NBFC. So real estate is going to be huge impact. So number one, sir, it is sir point in time or over time, sir, recognition is happening in the beginning. Number two things are SFC, okay, significant financing component issue is there. In case of IT software, same. So disaggregation bundle services are there, and you have to determine each element. Number two, SFC is also a problem here. In case of telecoms, sir, here also that segregation has to be done because there are front loading things which are happening in case of the segregation by SSP, which I gave you an example of mobile handset. Pharma companies are different milestones which are uh, achieved in case of variable consideration. So you don't have to recognize it upfront. That is a requirement. Okay. At tech companies are yes, you just have to don't do it upfront cash receipt, not equal to upfront revenue. So you are receiving the whole amount today. Maybe some study IQ, maybe some despisos or any other thing, but you don't have to recognize the revenue. Hospitality, yes, loyalty points. There is going to be a focus on loyalty points, etc. items and how the breakage, how the usage of these loyalty points are going to happen. So now the ambit is going to become very, very huge. Okay, because we have to determine and we have to explain, mention all these things in our financials. Okay, sir, manufacturing. Okay, in manufacturing there is a bill and hold, there is a repurchase agreement. So you have to focus on the control, you have to focus on the time, and both the things are happening when these things are actually changing hands. So we have to focus on that. In case of export and trading, sir, you have to be very, very focused on the revenue cut off near year and item, especially. So cut off, etc. and different terms are there. So in case of agriculture, of course, variable pricing and collectability, some government exemptions are there, some contract classifications are there. So focus on different industries, impact on different industries is going to be different, but it is going to be huge. Okay, sir, is it going to change only PNL or is it going to change the balance sheet also? So if we are thinking that only PNL is going to change, the answer is no. Sir, balance sheet is also going to change. Although it is not as a change, it is not mentioned. Because sir, what is going to happen is the performance is going to be very, very strictly monitored. So in that case, sir, your balance sheet items are also going to change a little bit. Sir, in case of contract assets, sir, especially if in case of IT implementation, you have to see uh, a focus is going to be more on the contract asset. There is going to be more increase in contract asset, contract liability, both the sides, because you are not going to recognize everything in the revenue, and you are going to be more mindful of the amounts which need not be part of your revenue now anymore. What about the cost to obtain contracts? Sir, it has to be amortized or expensed right away. If a contract is going to be completed within 12 months, then expense, otherwise amortize. Cost to fulfill the contract. Sir, again, you have to amortize over the benefit period. Okay, there are some refund liabilities, some there are returns, etc. So then for those expected sales return, you have to book a liability. Sir, the customer money is not your revenue, then it is your contract liability for which you have received the money, and there is going to be a refund. And it is different from, I'm not talking about India's 37 on the provisions. I'm talking about the sales where the refund possibility is there. So you have to put it as a contract liability. Advance from customer is going to disappear, and it has to be contract liability, absolutely 100%. This I have covered. What it is going to change, and we know already the difference between the contract asset and trade receivable. But trade receivables are unconditional right. Only the passage of time is needed, otherwise nothing else needs to be done. So, but in this case, something else needs to be done. Maybe some performance obligation needs to be done, some milestone needs to be reached, or something needs to be approved, something needs to be certified, and only after that it can become my revenue, it can be invoiced. But here everything is done and dusted, only the payment is awaited from the customer, whatever is the credit period, 30 days, 50 days, 1 year, oh not 1 year, 30 days, 50 days, 90 days. So that is going to just time passage, right? Now, what it is going to change? Sir, of course, it is going to change the current ratio, current asset and current liability. Absolutely, sir. It's going to change because the liability presentation is going to change. So revenue, timing, sir, EPS volatility is going to be there because now, or you can say it is going to be more streamlined. Number three, sir, working capital matrix is going to shift. Yes, definitely 100% it's going to shift. Day sales outstanding, this might change also because sir, the sales might change. The revenue from the core, the operating revenue might change also in this case. EBITDA composition is going to be affected by different P&L categories. We know that already. Okay. Sir, what is going to be the checklist? Yes, you have to take focus on the 5 steps. You have to focus on the new P&L categories. You have to do the overtime test. Okay. What is the going to the payment? What is going to be point in time, or what is going to be the impact? What are the critical concepts that we have covered? SFC, constraint, principle versus agent, MPM, SSP. We have all done. Sir, these are the practical experience that we have covered already. All right. Sir, now this is the statement of P&L which is there, and it is going to be part of this, and these are new items which are there. So operating and operating profit is going to be part of this. That's how it's going to be calculated. After that, you are going to get profit before financing and income tax, then PBI, then profit for the year. It includes the income tax and discontinued operations, and different items like depreciation, amortization, employee benefits, and impairment, etc. include these items also. Okay. Now, sir, there are some required subtotal, there are some common subtotal, there are additional subtotal. Now, what is the requirement? Sir, the required subtotal is MPM. No. Sir, common subtotal is MPM? No. But the additional subtotal that we are doing, additional item that we are putting, that becomes MPM. Okay. Now, sir, these are the subtotal that needs to be presented in statement of profit and loss as per Ind AS. So you don't need to do anything else for these. Sir, if it is a widely used subtotals that are not mandatory, but it is common, then there is a list also of subtotals, such subtotals, so that is fine. Then there are other subtotals which we do, or other terminology that we use, sir, in that case, those additional items need to be defined as an MTM. And we know already, sir, 1st April 2027 is going to apply. So yes, you have to prepare as per Ind AS. But do you have to restate the comparative period also? And there is going to be some opening balances requirement also, just like any other. And yes, with this, I just want to give this presentation a good and I am happy to take all the questions that might come.
Thank you, Arpreet sir. It was indeed a very insightful and comprehensive session. So we have received a couple of queries. So the very first question says, does Ind AS 118 require or permit the disclosure of extraordinary items in the financial statements?
Okay, so sir, basically what is going to happen is the entire PNL is going to be divided into three parts: operating and investing and financing activities, and the extraordinary items that, yes, definitely you have to mention it. It is part of the particular format that I have given you. Yes, and yes, from of so following that particular PNL format, you have to give the disclosure of extraordinary also. Yeah.
Then we have the next question. What are the exact recognition and disclosure requirements for MPMs under Ind AS 118, and how do these differ from existing non-GAAP disclosures?
Okay, sir, the non-GAAP disclosures that we are doing, that might be some disclosure that we are doing voluntarily, but this is number one mandate. Number two thing is when we are talking about different MPM, management performance measures, these are the terminologies, these are the various subtotals that I am using in my investor presentation. And no one gives the disclosure as part of notes to accounts for this particular item. So this has become mandatory. And for that, you don't not only have to give a reconciliation, but also a detailed note. What are those items? Number one. Number two, why you are using that particular subtotal, particular MPM, that terminology, how it is actually helpful for getting a useful information. Number three, the tax effect also you have to provide for that particular MPM. Okay, MPM. And fourth thing is it has to be consistent time over time. It cannot be changing time over time. Yes.
Very well answered, sir. Then we have the next question. In the context of Ind AS 118, how should entities approach aggregation versus disaggregation of line items to meet the useful information objective?
Okay, so this is the whole focus of the standard, because not only these are not very simple things that are going to be done. The things are going to be changed in the different accounting software also, in the different MIS also. So what you are going to do, first of all, sir, you have to determine, okay, these are the different things that we are having. These are different products, these are different geographies, these are different markets in which we are, and these are different sales channels in which we are right now. So in our cases, our revenue is a variable based on variable or fixed. Sir, our revenue is having some constraints which we are not factoring, or maybe we are factoring. So the inventory of the nature of the timing of the uncertainty of different revenue items needs to be there. First of all, first thing. Second thing is easier. Sir, all the investing and financing item have to be separated. That is an easier part. But if you want to aggregate and disaggregate things, so first thing is to take a stock of all the items, understanding the business entity and its environment. That was a very important, sir, essay, stand on auditing. So that needs to be kept in mind. Understanding needs to be built. And in terms of these things, which I have shown you on slide number 23, sir, I have shown you very detailed what needs to be there in the disclosure. So pick all those points and then you have to use all those points and think about everything. And maybe that is going to be the starting point.
Thank you for comprehensive answer, sir. Then we have the next question. It's about the manufacturing company, which is earning interest income from surplus funds parked temporarily in FDs. And under Ind AS 118, should this be classified under operating or investing, considering treasury activities are incidental to its main business?
Okay. No, sir, not at all. You cannot do it in the operating activity. So it has to be definitely in investing activities. That is the whole purpose, sir. The focus and the function of a company is to manufacture the product and sell or whatsoever, but not to park the funds, not to generate the revenue. Yes, generating revenue is not bad. Generating income is not bad. But the customer or the so not the customer, the investor should know, okay, is this company good in core business, or is the company's treasury team is very good in investing? So ultimately, I am investing in steel, Tata Steel, because of this, it is steel company, not because it is able to manage the cash flow. So yes, it has to be in investing.
Okay, sir. Then we have two more questions. A real estate company earns rental income and also sells properties. So how should it classify these different income streams under Ind AS 118 categories?
Okay, so both the income are going to be your main income. So yes, these both of these form part of the operating activity. And when we talk about disaggregation of revenue, this aggregation is for the very this disaggregation for the I can hear my voice back. I don't know how. Okay, this disaggregation of revenue is the real purpose of this question only. Sir, you are going to divide. Okay, the revenue you have told. Now you are going to disaggregate or divide it as per your product, divide it as per different markets, divide it as per, for example, in your case, it is rental income also and sale of property also. So you are going to give a segment kind of reporting in case of this India's permanent.
Okay, great, sir. Then we are moving towards our last question, which is why is the impact and relevance of Ind AS 118 considered comparatively lower for banks and financial institutions than for industrial and manufacturing entities, sorry.
Okay, why it is so? Number one thing is, of course, on the banking in AS are still under consideration. Number one thing is. Number two thing is, if you see the banking business, entire business of the banking is in the business of financing only, is in the business of investing only. The banking is already having a lot of financial instruments. The banking is already implementing a lot of FVTPL, fair value through PNL. Okay, it is implementing all those things which we are talking about already. First of all, the nature of business is completely different. There are two things in the world, sir. One is a banking entity, another is a non-banking entity. Sir, apart from that, nothing else. Okay. This is what I say always. So yes, both are on the other sides of the coin. Second thing is, when you talk about banks have a very good information system in place. They are so bank has two things only. One is money. Second thing is information system. Two things run the bank. And in case of banking, these information, if implemented, if required, banks would be easily able to bring all these information. But for the other type of entity, you need to take a stock of different items, and only then you are going to be. And it's a big exercise. Let me tell you. You will see after going back to your offices, you will see how big this exercise is going to be, and this is going to be a big change, revolution, not only in terms of the investors that they are going to have, not only in the terms of the work that we need to do, but also it's going to be a major upgrade. Maybe not one session, maybe multiple sessions are required for this. Deep dives are required. Maybe in the future, if I get an opportunity, I will take not this part, but maybe step by step implementation, what I'm going to do. This was just an overview, sir. Abito, you have to really start. This is just the beginning of the journey that is happening. And for the banking, of course, all the things are already in place. So it's easier there. But and second thing is the implementation part, which is under consideration.
Thank you, sir. I believe that detailed explanation from your side answers the question. So that was the end of all the questions we have received so far. So thank you so much, sir, for such an insightful and enriching sessions and also addressing the queries very well. Your ability to break down a complex standard like India's 118 into such a clear, structured, and practical perspective was truly commendable. And the way you connected technical concepts with real world application has certainly made the session extremely valuable for all of us. I'm sure all the participants would agree that your depth of knowledge combined with your engaging delivery has made the session both informative and thought provoking. So, on behalf of the Accounting Standards Board of ICAI and all the participants, I extend my heartfelt gratitude to you for taking out your valuable time and sharing your expertise with us. And we look forward to many more such insightful sessions from you in the future. So thank you, sir, for your valuable time. And thank you all the participants for their undivided attention. It was truly a masterclass on financial reporting. So
Thank you. Thank you.
Yes, sir.